Awesome. Hello, good morning. Thank you, or good day, I should say. Thanks everyone for joining. Appreciate you. Before kicked off, I think the main goal today is to talk about, or I guess the main idea I want to folks to leave with is most people end up overpaying the IRS, not because they want to, but because they think it's too. Not because they want to, but because they want to wait until it's too late. So, we're getting towards the end of the year. So I thought this would be a good time to kind of remind folks of what are things that you should be thinking about. What are the moves you need to make now that can really save you thousands of dollars? Some of these things are things that were considered, maybe you had planned for, some of you had not planned for, and they're just new things that have kind of come up in your life and new circumstances. So here to talk about, what are some of those year-end tax planning moves for 2025 and some things to kind of start thinking about as things progress in 2026. If your situation will change in 2026, if you have a sale of a property, sale of a business, or some other income that you weren't expecting, now's the time to start thinking about how you're going to work towards that new adjustment. Or if your income decreases, the same thing. How does that kind of look like? I think ultimately the goal, how I set this up, is for folks to understand what is their tax situation, what have they done to optimize it, and there be no surprises, right? So you should be either paying or receiving a refund in line with whatever this plan is. Obviously today I'm talking about general advice, but specific plans, that's really the main goal. So awesome. So state of tax landscape for 2025, there's been some updates. Lots of folks heard of the big beautiful bill, and that passage has reignited some of the things that were previously going to expire, and specifically surrounding bonus depreciation. That's a big one that folks are really, really excited about, because you can accelerate that depreciation for those assets into current year if you meet the qualifying things, qualifying criteria. So that's an exciting way, simple way to offset your current year income. So, we're November 19th, so we're about the end of the year, but now is the time that you can maybe put some of these purchases into place. And lots of folks joke, if you see a brand new G-Wagons, that's a lot of reason why, because of the fact that it meets the weight requirement for being able to obtain the bonus depreciation. So that's exciting as well. Inflation adjustment and bracket changes. So every year there's an adjustment, and this year there's some interesting adjustments for folks over 65 years old. They get an additional $6,000 in a standard deduction without having to do anything. So there's lots of exciting things, and there's some new compliance rules that the IRS has sent out to safeguard taxpayers and make sure that professionals like myself are safeguarding your information and providing you the right clarity as to the use of that information and how that's going to be impacted. So I talked about bonus depreciation, and so that's really exciting because now you can accelerate the depreciation. So for vehicle, or going back to my example of a G-Wagon, you can depreciate over a vehicle over 5 years. But because if you meet the specific requirements for business use and it's the right weight, right? So making sure it's over 6,500 pounds, you can deduct the entire purchase price. If you had a good year and you are trying to offset $200,000 in income and you purchase this $200,000 vehicle, you are able to offset that gain for this year. That does not mean that you had to pay cash for it. So I think some people get tripped up with that. You can still finance this vehicle. And the same goes for real estate, right? Under certain condition, if you qualify under real estate professional status, you can take advantage of bonus depreciation and depreciate these items in the current tax year. But you don't have to buy the property cash, right? You can still obtain bank financing and a 30-year mortgage. That will not affect how depreciation is working. There's also some shifting tax credits. So I've talked on previous webinars about opportunity zones in real estate. So those have shifted because there's now additional areas. There's rural areas that are now included in the opportunity zones, so you're able to better take advantage of that. There's additional credits for overtime pay, right? So we've heard a lot about that. So there's, with the government shutdown, there's going to be some rush to get the new tax form, but there's to the 1040, they added a bunch of schedules, and most folks are not aware of this. There's a Schedule 1, a 2, a 3, and so now they're adding a Schedule 1B, which will allow us to kind of consider the overtime for folks if you received overtime, and how that's going to impact. You're able to deduct the overtime pay so you don't pay tax on that. There's also some provisions for vehicle loan interest and being able to deduct that and being able to deduct that directly. So not part of additional deductions, but actually so it's aside from the standard deduction. So really exciting things that are kind of shifting and are available now that will impact folks' overall tax liability. And when I speak about tax liability, I am speaking just about income tax, because as you earn wages, you are also responsible for Social Security and Medicare on wages. And Social Security and Medicare are mandated a percentage of your income. Social Security caps out at a certain level. And so every year it changes. So it's, I think, $65,000 this year. So they will just continue to shift as what's the maximum amount of income of which you will pay Social Security. But those are mandated percentages, and those are still in effect regardless of the income tax benefits that we're talking about, which is generally what you file when you file a 1040 tax return for your personal taxes. As the year end, there's lots of deadlines that folks kind of think about. Well, one of them is you cannot go back with certain exceptions and make a transaction in 2026 that will impact your 2025. So now is the time, if there's going to be something that you're going to do to offset your income, if you have additional expenses in your business, now is the time to have those expenses, and not in January 1, because come January 1, you can't say, I had a $200,000 gain in my business. I have this expense from 2025. It's too late. You cannot go back for that. Yes, there are some exceptions and some special cases, but 99% of the cases, you cannot go back into the previous tax year. So if you have those expenses, you do that now. If you have a tax bill and you've been making estimated payments or haven't been making estimated payments, you want to possibly consider doing that so that you're not paying a penalty for underpayments. So if you are, if you have a several $1,000 tax bill that you're anticipating, by making estimated payments, generally you want to do them quarterly, but let's say your gain happened in the fourth quarter, you want to go ahead and make an estimated payment of what you think the tax bill will be for that. Folks are sometimes worried, well, what if I paid too much? Well, you will get a refund for it. If you pay too little, you will pay the difference. But what we're looking for on this is to offset the penalties that could be in place for underpayment of tax. The other thing that folks also often miss is that IRAs is a good example of something that you can make a contribution up until April 15th of the following year and apply it to the previous year, but the same cannot be said for a 401k. So if you Want to max out your 401k, you still have some time, right? It's 23,500 is the max employee contribution. You still have a little over a month to make that adjustment and make sure that you maximize your 401k contributions for this year. Right. So I talked actually through most of these, but talked about timing, making if there's another opportunity here for revenue. We talked about expenses. If there's an opportunity for revenue to be pushed into 2026, that's if you run a business, that's something to be mindful of. I've had clients in the past who one of their clients has paid them December 30th, and so being on a cash basis, payment received December 30th does not give them sufficient time to maybe have the expenses that they would have necessarily had as a result of that revenue, and so they now have a bogey. They have an additional income that will go straight to the bottom line, and they'll be responsible for taxes. So that's something to consider as you're maybe invoicing clients or having conversations with clients about making key payments, especially if they're prepayments for services, making sure that those happen in 2026 as opposed to 2025. Or if you need them in 2025 and you want to go after those receivables or that income, then try to get that in before the end of the year so that you can use that. I talked about the contributions. I can't stress that enough. Max them out if for maximum tax benefit. HSA is another. We talked about IRAs, Ks. Talked about equipment purchases. So I talked about I talked about it somewhat when I spoke about depreciation, but now is also the time to purchase certain equipment. And there's other. I know I talked about the G-Wagon, but there's other business-related equipment that can be purchased and can be subject to Section 179 or the bonus depreciation that will allow you to deduct those expenses in this tax year. And that's, especially if you had a good year, it's a time to invest in your business for continuing growth into 2026. That's really the ultimate part of this, is how do you push that potential tax gain or that taxable gain into the future, right? So it's how deducting things now as opposed to over time will allow you to do that, and then that becomes the strategy for following years. How do we do this? How do we continue that? And all of that is really part of a comprehensive tax plan. And we started off the conversation saying folks don't think about it until it's too late, and I think that's really ultimately the goal. Is you want to have a plan in place, and you would like to have that plan executed and in such a way that what's going to happen. So come the time to file your taxes, filing your taxes shouldn't be a surprise, right? Time and time again, I meet with folks and I say, I don't know what's going to happen this year. 3 years ago, I had a $5,000 refund. Last year, I paid $8,000. I have no idea what's going on. And I think that's ultimately the goal of having conversations and having a tax plan in place, is to understand that what's going on. It's a good problem to have, to pay money in taxes, but you don't want to pay more than you have to, and you want to understand where that's coming from. So that's really key. Now is also a good time to review, if you have a business, that what is the taxable entity type, right? And I know I put it on here as S Corp, C Corp versus LLC, and it will say that the legal entity type, an LLC, will allow you to be taxed as an S Corp, as a C Corp, as a partnership even, or as a disregarded entity, which is what we meant there with LLC, which is what I hear a lot of people say, I'm an LLC, I'm taxed as an LLC. It's a disregarded entity, means it flows through to your Schedule C on your personal taxes, and the gain from the Schedule C is subject to Social Security and Medicare, so the payroll taxes. So that's one of the reasons that if you started off something small and it's now growing, you maybe want to look at it and say, what are other things that I can maybe do to not have, right? We talked about income tax being part of it, but you also have the payroll tax, Social Security and Medicare, which are mandated percentages. So there's some opportunity there to review that, and if it makes sense, make a timely election, for example, to become an S corp, right? That one has a timing consideration. So if that's something that makes sense, right? That's part of a tax plan, a tax review, then you would, make that election in the first 2 months of the year, so that you are able to obtain that for the following tax year. So it would not apply to 2025, but it will apply 2026 onward. So that's a timing consideration that you have there. There's also R&D credits and energy credits. Charitable giving is always a good idea. So there's some opportunities there. You could do donor funds for stock. And then if you had gains in one part of your life, there's an opportunity to look at what are some tax losses that you can maybe take this year. So maybe you have some stock, some mutual funds, some other investments that have a loss, and it maybe makes sense from a tax perspective to take that loss in 2025 to offset that income for 2025, and then not have such a high tax bill. So yes, you have a loss, and it's just now recognizing it in this year, as opposed to waiting until next year. Excuse me. So how we've helped our clients, we've talked a lot about most of these things, but we properly structure business to minimize taxes and what makes most sense for their investment goals. It's not a one size fits all. There's no YouTube or TikTok or Instagram video that's going to give you the key. It's really dependent on who you are, what you're doing, and what your goals are, and that's really what goes into that consideration. They're looking at various forms of asset protection. So if you're not currently an LLC or corporation, those sort of things to consider depending on what industry and what things you're doing today. There's some opportunities there. The other thing is implementing strategies to maximize tax savings. So we work up a tax plan. We do a review of your current tax situation. We come up with a tax plan for, let's say, for 2026, and we help you implement and manage that with touch points, quarterly or monthly, depending on the complexity of the plan, to make sure that things are marching along, so that by the end of the tax year, you know what are the tax savings that you've attained, and then come 2027 and you're filing your 2026 tax return, there are no surprises. And that's really the goal, is not just the tax savings, but also eliminating the surprises. So I think that also increases folks' stress and anxiety about taxes, right? Not understanding what's going on. I think that's a really key component of what I do and what we do as a business to make sure that folks do that. And if you do have a tax bill, let's make quarterly payments. Let's get these quarterly estimates out, so that come tax time, you are not being taxed you're not being penalized for having underreported and underpaid your income. And if your income shifts, right, as we have a plan, we go working through these goals of adjusting, right? Hey, my income actually is going to be lower, so let's make smaller estimate payments. Or actually, we had a great quarter. Let's go ahead and increase the payments because it's going to be my income is actually increased. Or there was a one-time event of a sale of a business asset or a property that are going to impact my tax for the following year. So, saving money on taxes, you increase your profit, you grow your enterprise value, you increase your net worth. I say that, and that's really important because you're looking at your overall tax, but at the same time, there's bad ideas about saving money on taxes, right? There's a school of thought specifically when it comes to 1031 exchanges for properties, that since you have a constrained time frame, that you rush into making another purchase, that maybe is not the most ideal investment. And so, yes, you obtain the tax savings, but now you made a poor investment that could impact your capital. And so you don't necessarily want to jump into those things as you kind of move forward. Talking about some common Q4 pitfalls, poor documentation. I think the IRS really expects folks to document things contemporaneously as you're having these expenses or these income events, that you're not just going off of memory, right? You have some sort of documentation. It can be very simple, but you need to have something that's as it's occurring. There's missing deductions. We've talked about a bunch of deductions that folks can take advantage of that they may or may not be taking advantage of today. And there's the entity mismatch. So we talked about, should you be an S Corp? Should you be a C Corp? Should you be a partnership or a disregarded entity? And there's lots of pros and cons for each, and they're very unique, I think, to not just industry, but individuals' goals. Lastly, late planning, and I know we're talking about this Q4 end of the year, and we're talking about late planning. You still have some time. You're just much more limited in terms of what you can do in the next basically 40 days or less, right? Because things really shut down once the holidays kind of come through. Real client example. So we had a real estate investor who reduced his taxable income by $45,000. So what did we do for this client? So we purchased a multifamily property, and we used a cost segregation study as well as an entity restructuring. So we had initially set out to be a disregarded entity, which would have made his earnings subject to self-employment tax. He also did not have a cost segregation study performed, so was relying on the appraisal. So the amount, the total dollar value of what could be depreciated, we were able to increase through the cost segregation study. And because of the useful life of some of these items, right, appliances can be depreciated over 5 years instead of what's generally 27.5 years, right? We're able to now lower his tax bill during the first 5 years. And we did all of that before the end of the year. We did this year, and we're able to demonstrate an immediate ROI because we know we have a tax plan. We implemented this plan, and we know what are the tax savings that we're going to obtain once we file our tax return in 2026 or 2025. Zero surprises. That is the ultimate goal. Zero surprises, a full understanding of what's happening, and managing it actively to reduce stress, reduce the taxable anxiety, and everything that's related to that. So, what are your next steps? Implement these strategies before December 31st. If any of these, if you're already doing all of these, congratulations. That means you've been well informed and are set to be successful. If there's things that piqued your interest, feel free to reach out to me. Review your income, review your deductions, and your entity structure, and do these things before December 31st for this tax year. We're going to also send out a year-end tax checklist for folks who attended the webinar, and folks who missed us as well. We'll send it out so that you have some items that you can review and take action on that. Like I mentioned, I'm here. If you have any questions, happy to do a free year-end tax review. If you're a current client or not, happy to kind of review what you have going on and see if there's any way that we can assist you